Do you want to make 20% as a rate of return per year? Well, listen up. I think you're going to like this. You can invest your individual retirement account or IRA and qualified plan assets, 401ks, Roth 401ks, defined benefit plans, etc., in different ways. As a matter of fact, you could, yes, you could put those assets into real estate and sometimes make a nice rate of return. Who knows, maybe as high as 20%. Few people know this. You're going to like this. Kenner French with vastsolutionsgroup.com. We do tax, finance, and artificial intelligence for entrepreneurs. We've saved hundreds of people thousands of dollars, tens of thousands of dollars, even hundreds of thousands of dollars over the 50 years we've been around. We've consulted people from north to south, east to west, trying to maximize their retirement dollars. Please, by the way, don't forget to like and subscribe to this video. I'm gonna guess you're gonna like this. By the way, stay tuned. You're gonna get a little bonus at the very end. You know, at first thought, putting real estate into an IRA or a qualified plan may seem like a off-the-wall idea. It is one that actually you might consider depending upon your situation, but you must be aware of all the specific rules. The rules can be mind-boggling, but sometimes the decision can be a wise one. The concept is not new, but it really has been gaining acceptance lately. Only a small percentage of qualified plan assets are invested into real estate. Now, remember, we're talking IRAs, 401ks, etc. The 2007-2009 bear market led some IRA owners and 401k trustees who were in charge of plans to look for other alternative investments. That was when the term self-directed IRA or self-directed trustee plans entered into the investing lexicon. As the stock market tumbled, a cottage industry of the investment firms emerged, urging IRA and 401k trustees to put money into real estate, and specifically even real estate notes and real estate investment trusts. Many instances of financial professional may resist your inclination to invest those assets into IRAs and 401ks. They probably do not know nearly as much about those types of investments. They are probably somewhat knowledgeable about investing in stocks, bonds, mutual funds, and all the like, but not typically are they trained in real estate. At times, financial advisors do not have a compliance arm that would allow such an investment. Also, maybe more importantly, in some instances, the advisors cannot get paid on such a transaction, such as an example, duplexes, income-producing properties, hotels, etc. With respect to IRAs, no law prohibits an IRA owner from doing this, but many financial firms serving as IRA custodians do have rules against such. So if you want to invest in real estate through your IRA, you must first check to see if your IRA custodian will allow it. If it is allowed and you are to proceed, you're on your own. Your IRA will not be helped in any way by another outside group. It would be you who is in charge of the assets. The custodian will make no attempt to help you, and you will be alone and responsible for your investment decisions. That is a risky deal, no doubt, but if you're willing to make it, it might make sense. Now, with qualified plans, again, 401ks, defined benefit plans, where the business owner is what's called the trustee typically. The result is the entrepreneur typically can make a determination of where the assets are invested and as it relates to stocks, bonds, mutual funds, etc., etc. Normally, the trustee will hire an advisory firm to help in this regard, but also can go it alone if the situation makes sense. Anyway, the trustee can make the choice to invest into real estate per se. Now, it can be an income-producing piece of real estate. It could be land. It could be a duplex. It could be a building, a hotel, apartments, anything. By the way, all have specific rules. If the company has employees who are not related to the company owner, a significant amount of care needs to be taken into account. The liability falls onto the shoulder of the business owner, again, who probably becomes the trustee. The business owner makes sure the retirement of the employees/participants goes well. This is super important. The business owner now must jealously guard the interest of the participant monies. Very important. Holding real estate in your qualified plan means looking at it differently. To a lesser or maybe even to a greater degree, the portion of the amount in the real estate transforms from a dedicated retirement savings vehicle to a real estate investment vehicle. Now, if you are more knowledgeable about, let's say, the housing market than the stock market, you may prefer to invest real estate assets. Now, you got to be careful. Whether you know volumes about real estate or not, you must abide by the particular regulations and mechanics involved. Self-dealing is outlawed legally. You can buy any form of real estate with your IRA and qualified plan assets, but you may not buy real property that will be used as your home or a place of business. Your IRA and qualified plans, now, which both are defined as trust, by the way, may not be purchased by real estate whatsoever. I'll just cut to the chase. Can't buy real estate specifically that you're living in or that you're using as a benefit for anyone involved with you, meaning as a family member or otherwise. Now, if we're talking about an IRA, you buy or sell real estate through, let's say, an IRA custodian. The mechanics of making the actual transactions are fairly straightforward. You instruct your IRA custodian to authorize the purchase or sale of a property, providing the required documentation facilitate that purchase or sale. The IRA custodian then commences to buy or sell the property for your IRA, with the title to the property vested in the name of the custodian. You have to have enough IRA assets to cover 100% of the property management and property-specific expenses linked to that transaction. Failing to have sufficient assets to cover those costs may mean penalties or forfeiting tax benefits. Talking about qualified plans now, specifically in 401k plans and defined benefit plans. Now, if you are what's called the trustee, or if you've hired one, you need to have an accredited banking institution to comply with many of the same functions as an IRA custodian. You will need some consultation, but the concept is basically the same as what I've previously mentioned. Proceeds from the sale or rental income go right back into the IRA or the qualified plan, depending on which one you're talking about, or both, by the way. This is necessary so that the account may retain its tax deferred status. These newly invested assets get the same amount of creditor protection that the IRA and qualified plans normally get. The level of protection varies per state, though, so be careful. And IRA assets are not protected against lawsuits. There's a lot of caveats there. Do you need to form an LLC? Some owners of self-directed IRAs and qualified plans do just that, so they can have a checkbook control, as you've probably heard or may have heard. How does this work? The LLC sets up a bank account for the IRA owner or the qualified owner, depending, allowing he or she to write checks on behalf of the IRA or the qualified plan. The LLC facilitates transactions for the IRA owner and also plan trustee, depending. With respect to IRAs, there are some notable benefits to adopting the LLC structure. Timing can be everything when it comes to a real estate transaction, and having a checkbook IRA, as some people have called it, gives you a chance to buy foreclosures on the steps of your local courthouse with IRA assets. An LLC structure may lower some of the custodial costs associated with the IRA administration. It also permits the IRA owner the option of handling some property management duties, such as bill paying, maybe advertising and collection of deposit rents, etc. On the other hand, since an IRA is a trust from the inception, the LLC structure is kind of technically superfluous. Now, I should note, we have some advisors who suggest using an LLC, and we have some who suggest not doing so. Again, each circumstance depends upon the circumstance, and you get that. It should be noted, sometimes investing real estate assets into qualified plans does not make good sense. Specifically, taking a tax-advantaged asset like real estate and investing it into a tax-deferred environment goes against logic. But then again, if someone has no access to money but wants to put money into real estate, well, there you go. Might as well do it, depending. If you want to hold real estate in an IRA or a qualified plan like a 401k, you need to speak with a legal and a tax professional first. You must understand what you're getting into, and the full tax details are beyond the scope of this video. This could be a 3-hour video, so each circumstance is different. Using your IRA and your 401k to invest in real estate could be an auspicious move. It could also breed complications. Our company, vastsolutionsgroup.com, has a nice little niche in this area. We potentially could help you out, or at least you know some of the specifics involving IRA investments into real estate and also qualified plan assets into real estate. Once again, Ken French with vastsolutionsgroup.com. Oh, by the way, I said if you stick around, you're going to get a little gift, a little surprise. You get a copy of my book, since you've waited this long, The Entrepreneur's Manifesto, a collection of smart financial advice. As well, you're going to get a gift card for $50. All you have to do is email us at einstein@vastsolutionsgroup.com. Once again, einstein@vastsolutionsgroup.com. You'll get this and the Starbucks gift certificate. Thanks for waiting this long. Hopefully it's been of value. If so, pass it on to a friend. Or, hey, you can even have them, or you can call us at 888-808-8278. And once again, www.vastsolutionsgroup.com. And we really appreciate you taking the time to watch this video. We are really excited, potentially, to do some business with you.